Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AtlasClear.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, we all love a good survival story, right?
Oh, absolutely.
Like you read those accounts of someone getting lost in the wilderness, fashioning a shelter out of pine branches, and, making it out against all odds. It's thrilling.
Right, everybody loves an underdog.
Exactly. But in the world of corporate finance, true survival stories are incredibly rare. I mean, usually when a company enters a financial death spiral, there's no dramatic rescue. The math just caves in, the creditors circle, and the lights go out.
Yeah, that is the grim reality of the markets. Because in finance, momentum is really everything.
Yeah.
When that momentum turns negative, it creates this gravitational pull that is almost impossible to escape. The debt gets more expensive to service, your strategic partners get nervous and pull back.
And then the top-tier talent leaves for more stable ground, right?
Exactly. It becomes a textbook downward spiral that just feeds on itself.
Which is exactly why the situation we are analyzing today is so uniquely fascinating. We are unpacking a corporate survival story that honestly reads like a masterclass in escaping that exact gravitational pull.
For sure.
We're looking at AtlasClear. And we're really putting them under the microscope because they didn't just survive a highly distressed situation, they somehow flipped the script entirely.
They really did.
They moved from the absolute brink of collapse into massive revenue growth. And now they're executing this really aggressive strategy to roll up niche financial sectors.
And for you listening, it is so crucial to understand that this isn't just a post-mortem of a corporate turnaround.
Right.
We are examining the actual architecture of wealth building here. We are looking at how a management team takes a company off life support and builds what looks like a formidable, deeply entrenched infrastructure moat.
It's a transition from a narrative about sheer desperate survival to a story about platform scaling and, asymmetric potential. Okay, so let's unpack this systematically, because before we can even begin to talk about future wealth building potential, we have to verify that the ground they're standing on today is actually solid.
Yeah, you have to look at the foundation first.
Right. We need to look at the balance sheet miracle that happened here. Let's look at their fiscal second quarter of 2026. So that's the quarter ending December 31st, 2025.
Okay.
They reported a staggering 84% revenue growth. But honestly, the absolute craziest part of the filing is the equity. Stockholders' equity hit a positive $21.7 million.
Yeah, and we really have to contextualize that $21.7 million to truly understand the scale of the financial engineering that took place there.
Because it wasn't always positive.
Not at all. At the prior fiscal year end, they were sitting at a $6.8 million deficit.
Wow.
And if you go back to their absolute lowest point, stockholders' equity was at a massive negative $40 million.
Wait, negative $40 million? That is a $60 million swing from the bottom.
Yeah, it's pretty incredible.
I mean, it's like a sinking ship where the crew didn't just patch a hole in the hull, but somehow managed to install a high-performance speedboat engine while completely submerged underwater.
That's a great way to picture it, yeah.
We know they cleared out roughly $54 million in legacy debt and expenses, but you don't just find $54 million in the couch cushions, How exactly did a distressed company pull off that kind of balance sheet cleanup?
Well, they didn't just write a check, because they obviously didn't have the cash. They financially engineered their way out of the hole.
Right.
This was largely a de-SPAC hangover. For the listener, a de-SPAC happens when a private company goes public by merging with a blank check shell company.
And those can get really messy.
Extremely messy. It's a process that is notorious for leaving the newly public entities strapped with toxic legacy debt and incredibly complex share structures.
So how did they fix it?
To clear that $54 million, AtlasClear essentially had to restructure those legacy obligations. They converted toxic, expensive debt into equity and aggressively cut operational fat.
Okay, so they basically took the pain of dilution up front.
Exactly. They wiped the cap table clean so the core business could finally breathe.
And that brutal restructuring is what led to them shedding their going concern warning in the September 2025 quarter, right?
Precisely. And getting a going concern warning removed is essentially like having a massive impending foreclosure lien lifted off your house.
Oh, man. The relief.
Right. Suddenly, banks are actually willing to do business with you again. Strategic partners will return your calls, and the neighborhood stops expecting you to get evicted.
Yeah, it removes the existential pricing overhang that just suffocates a stock.
Exactly. So today, instead of fending off creditors, they are sitting on a war chest of $46.2 million in cash and restricted cash, with total assets up 21% to $77.6 million.
Okay, but let me push back here for a second. Because cleaning up your balance sheet, that's a defensive move.
Sure.
It stops the bleeding. But it doesn't automatically create an 84% jump in revenue. You don't just magically generate that much new cash overnight just because you fixed your debt structure.
No, you don't.
Right, so what are the actual underlying mechanics driving this sudden influx of money?
That is the pivot from defense to offense. And it really comes down to active execution at their subsidiary, Wilson Davis.
Okay, Wilson Davis.
Yeah, Wilson Davis is a specialized clearing firm, and they are seeing significantly higher client activity across three main pillars. You have commissions, clearing-related activities,
Yeah.
and specifically stock locate services.
Let's pause on that last one because stock locate services sounds incredibly niche.
It is, yeah.
But from my understanding of the plumbing of the market, it is a highly lucrative service. Like when a hedge fund or a retail trader wants to short a stock, meaning they're betting the price will go down, they legally have to find or locate those actual shares to borrow first.
Right. You can't short what you haven't located.
Exactly. And if it's a volatile small cap stock, those shares are incredibly hard to find.
You nailed it. And clearing firms with robust networks, like Wilson Davis, they charge a premium to locate those hard-to-borrow shares. It's a very high-margin business.
Interesting.
But to understand why this revenue surge is so critical to the long-term wealth-building thesis, we really need to look at their operating leverage. Management has identified a very specific structural threshold, which is $14 million.
Right, their operating cost base. But just to be clear for the listener, this isn't just basic fixed versus variable cost accounting. We are talking specifically about the cost of maintaining a highly regulated financial tech stack, correct?
Exactly. It costs them approximately $14 million annually to run the heady infrastructure.
So like servers and compliance?
Yeah, we are talking about maintaining the server space,
Yeah.
employing the specialized compliance teams, running the risk management algorithms, and paying the regulatory fees.
That $14 million is basically the price of admission to operate a clearing firm.
Exactly. But the beauty of this specific tech stack is that once you surpass that $14 million threshold, the marginal cost of adding a new client approaches zero.
Ah, because if you bring on a new broker-dealer, you don't need to hire a whole new compliance department or build a new server farm.
Exactly. You just plug their order flow into the digital plumbing you've already built.
Wow. So every dollar of revenue generated above that 14 million mark drops almost directly to the bottom line.
That is maximum operating leverage.
Sure.
And because they are now blowing past that threshold, it sets them up for explosive margin expansion throughout 2026.
Which proves the revenue surge isn't just a fluke, but it begs a massive structural question. I mean, if this business model is so scalable and so lucrative, what stops someone else from just doing the exact same thing?
Well,
We really need to examine their infrastructure moat because they aren't just resting on that 14 million threshold, right? They are aggressively targeting a totally underserved market.
yeah, and this is where the strategy shifts from just a good turnaround into a brilliant roll-up. The core moat for AtlasClear is their direct membership at the National Securities Clearing Corporation, the NSCC, and the Depository Trust Company, the DTC.
And they hold those memberships through Wilson Davis.
Exactly. Now, gaining direct membership to the NSCC and DTC takes years. It requires massive capital minimums and grueling regulatory scrutiny. It is the absolute deepest plumbing of Wall Street.
Okay, but hold on. Colossal incumbents like Fidelity and Pershing also have direct access to that same plumbing.
They do.
So if the plumbing is the same, why wouldn't those multi-trillion-dollar giants just swallow this entire market segment whole?
It comes entirely down to unit economics and legacy technology.
So.
The giants like Fidelity and Pershing operate on massive, entrenched mainframe systems. Those systems were built for sheer scale, not flexibility. They want to onboard massive institutional clients with vanilla, standardized needs. If, say, $500 million fintech startup or a smaller broker-dealer comes to a giant custodian, they often need customized APIs, specialized risk parameters, or bespoke onboarding processes.
Ah, I see the friction there. For a behemoth like Pershing, assigning a dedicated engineering team and compliance officers to customize a tech stack for a sub-$1 billion client just doesn't make mathematical sense.
Exactly. The administrative headache eats all the profit.
Right. It's like asking a cruise ship to stop and pick up a guy in a kayak.
That's a perfect analogy.
Yeah.
The giants largely ignore the smaller end of the market because the unit economics just don't work for their legacy infrastructure.
But for AtlasClear, it does.
Exactly. For an agile, tech-forward player like AtlasClear, that sub-$1 billion market is an absolute goldmine. And the strategic beauty of it is the stickiness of the product.
Sticking.
Yeah, once a smaller broker-dealer integrates their entire trading operation into AtlasClear's clearing API, the switching costs are astronomical. You don't just easily unplug your entire settlement infrastructure.
Right. It's like trying to change the entire concrete foundation of your house while you're still living inside it.
Exactly. You just don't do it unless you absolutely have to.
And AtlasClear clearly understands this market gap, which explains the absolute sprint we're seeing in their corporate execution. I mean, if you look at their calendar this past spring, it's a relentless pace.
It really is.
On March 23rd, 2026, they commence clearing operations for Dawson James. Then 2 weeks later, on April 6th, they onboard a third correspondent and sign a clearing agreement with a fourth.
Yeah.
And then on April 24th, they don't just sign another client, they drop a letter of intent to acquire ARC Financial Services, which is the actual parent company of Dawson James.
That pace of integration is just staggering. And the ARC Financial deal specifically is a masterstroke. It targets bringing the combined business to $45 million in gross revenue and $5 million in net income.
Wow.
And when you map that $45 million against the $14 million fixed cost threshold we discussed earlier, you really see that explosive operating leverage in action.
Okay, but let me jump in here and play the skeptic for a minute, because we haven't even mentioned that they also have a pending acquisition of Commercial Bancorp, which is a Federal Reserve member bank.
Right.
So let's map this out. They are clearing trades, they're buying retail broker-dealers, and they're buying a regulated bank. Being a one-stop shop for clearing, retail banking, and investment banking sounds amazing on a pitch deck.
It does.
But in reality, integrating all these moving parts, I mean, different regulatory bodies, different tech stacks, entirely different corporate cultures, is notoriously messy. Aren't they biting off way more than they can chew?
Look, integration risk is absolutely the graveyard of many ambitious roll-up strategies. You are right to point that out. You are merging SEC and FINMRA cultures with Federal Reserve and state banking cultures.
Exactly. It's a lot.
But if we look at the structural details of the Commercial Bancorp acquisition, it reveals something brilliant about how management is mitigating that specific risk. The deal is structured with roughly 73% stock-based consideration.
Oh, wow. Okay, that changes the dynamic completely.
Right. They aren't just handing the sellers a bag of cash and wishing them luck on the golf course.
Not at all. By paying for 73% of the bank using AtlasClear common stock, the sellers are inextricably aligned with the long-term equity vision.
Exactly. They are tying their own personal net worth to the successful, smooth integration of the platform. They aren't looking for a quick exit. They are highly motivated to hold the stock, aid the transition, and support the underlying price.
So they're basically tying themselves to the mast. Yeah. It strongly implies that the sellers who know the banking side intimately believe these cross-platform synergies will actually materialize.
And it makes total sense why a clearing firm wants a bank. It's about capturing the net interest margin, right?
Precisely.
Because when broker-dealers hold client cash balances, a standalone clearing firm has to sweep that cash into a third-party partner bank, and they split the interest yield.
Right.
But if AtlasClear owns their own Federal Reserve member bank, they sweep that cash into their own vault and capture the entire spread.
Exactly. And because those sellers are locking up their value in stock to capture that spread, it sends a massive signal of confidence to the broader market.
And we are definitely seeing Wall Street respond to that signal in real time.
We certainly are. We're witnessing a complete psychological shift on the technical charts. It's moving away from a distressed de-SPAC play where, retail and institutional investors are just waiting for the other shoe to drop to a legitimate operational breakout play.
Yeah.
The overarching sentiment right now is overwhelmingly bullish, scoring an 8 out of 10 on our internal metrics. And that is really driven by the density of the news flow. You had 4 massive operational catalysts dropping in just a single month.
And a major piece of that market reevaluation happened on April 6th, right? When Litchfield Hills initiated coverage on AtlasClear with a buy rating and a tangible price target of $1.
Yes, that was huge.
Here's where it gets really interesting from a market psychology perspective. A $1 price target from a sell-side analyst acts like a psychological magnet.
Oh, absolutely.
When a stock has been suffocated by existential dread for 18 months, investors lose their compass. They just don't know how to value it. Giving the market a solid mathematical anchor fundamentally alters the trading psychology.
It forces institutional algorithms and retail traders alike to recalculate their risk models. The narrative has permanently pivoted. It's no longer a story about basic survival. It's a story about platform scaling. When you factor in the ARK financial deal, it vaults AtlasClear from being just a niche back-office clearinghouse to a fully fledged capital markets originator. They are building a self-sustaining ecosystem.
Yeah, you originate the investment banking deal through your broker-dealer, you clear the subsequent trades through your own NSCC infrastructure, and you hold the cash deposits in your own bank.
Exactly.
And management is clearly feeling aggressive about defending this new position. They are actively and publicly opposing a proposed exchange rule change for the NYSE American.
Yeah, I saw that.
Specifically, they are fighting a rule that would raise the minimum price threshold from 10 cents up to 25 cents. Currently, AtlasClear is fully compliant under the existing rules.
Right.
But the fact that management is spending legal resources to contest this change suggests they are highly confident in maintaining their underlying price stability above those critical exchange maintenance levels.
It's a very telling move. I mean, if management secretly believed the stock was inevitably sliding towards zero, they wouldn't waste capital and legal bandwidth fighting an exchange rule about minimum pricing threshold.
Exactly. Why bother?
Right. They're operating and strategizing like a company that fully intends to be a permanent fixture in the market.
Okay, but let's take a breath here, because no wealth-building strategy is complete without rigorously stress-testing the thesis.
Always.
Before you listening get totally swept up in the bullish momentum of an ecosystem roll-up, we have to ask, what are the actual tangible risks here? Let's examine the bear case, because as much as we love a turnaround, the path is still littered with hurdles.
Yeah, and the most glaring hurdle is regulatory and execution risk.
Okay.
The entire transformative upside of this vertical integration thesis hinges on navigating incredibly complex multi-jurisdictional approvals. For the commercial Bancorp deal, they require explicit approval from both the Federal Reserve and Wyoming state banking regulators.
Which is never easy.
No. And for the broker-dealer acquisitions, they need the blessing of the SEC and FINRA.
Right.
If any of those agencies delay the process, or worse, outright reject the integration, the whole thesis stalls out. AtlasClear would be stuck as a standalone, smaller-scale clearing firm, and the massive synergistic upside just evaporates.
And we have to talk about the elephant in the room, too, the actual share count.
Yes. Let's get into that.
Acting as the voice of the skeptical listener right now, the core outstanding share count sits at roughly 150 million. But if you look at the fully diluted count, which factors in all those complex legacy instruments we talked about earlier, specifically warrants, which give early investors the right to buy shares, and convertible notes that have an exercise price of 75 cents, you are looking at a fully diluted float of around 207 million shares.
It is a big number.
Over 200 million shares is a massive float. With these new acquisitions being paid for in stock, aren't everyday retail investors just going to get their value watered down to absolute zero?
That is the classic, entirely justified fear. With any aggressive roll-up strategy, you fear that management is just printing shares like monopoly money to buy revenue.
Exactly.
But if we connect this massive share count back to the bigger picture, you have to understand the timeline of that dilution. That 200 million plus share count is largely a legacy issue.
Okay.
It's the residual scar tissue from the initial de-SPAC transaction. The critical insight for investors is that the company has already absorbed the vast majority of that dilution pain. And they did it while miraculously flipping their equity from a negative $40 million abyss to a positive $21.7 million fortress.
So the pain of that dilution is basically already baked into the current share price. The market has already digested it.
Exactly. The market is currently only valuing AtlasClear based on its standalone legacy clearing operations. The massive upside from the M&A synergies, the banking net interest margins, the investment banking origination fees, That is largely incremental optionality that the market has not fully priced into that 207 million share count yet.
That makes a lot of sense.
Furthermore, management has explicitly pledged that future capital raises will be accretive, meaning they will only issue shares if the revenue brought in outweighs the dilution.
Got it. And, there's actually a really interesting, highly speculative rumor floating around institutional desks regarding those regulatory hurdles we mentioned.
Oh, about Wyoming.
Yeah, management has subtly hinted that the Wyoming bank regulatory approval might actually be fast-tracked. Wyoming is known for having incredibly agile, forward-thinking banking regulators.
They really are.
So the rumor suggests approval might come well under the previously expected 12 to 18-month timeline due to this accommodating regulatory environment.
If that regulatory fast track actually materializes, it would force a violent, rapid re-rating of the stock.
Really?
Yeah, because the market models future cash flows based on a very strict timeline. If you suddenly accelerate the closing of the commercial Bancorp acquisition by, say, 6 or 9 months, all of those high-margin banking synergies hit the balance sheet that much faster.
Right.
The math fundamentally changes overnight. We will definitely get a much clearer picture of their regulatory progress and operational scaling when they report their Q3 fiscal 2026 earnings, which are expected to drop around late May or early June.
So synthesizing all of this, what does this mean for the listener trying to map out a concrete investment thesis? We are looking at a situation with a confirmed 8 out of 10 bullish score.
Yes.
AtlasClear has aggressively shed its distressed going concern overhang. It is organically printing 84% revenue growth through its clearing operations, and it is executing a ruthlessly aggressive vertical roll-up strategy to capture the sub-$1 billion market.
The ultimate takeaway here really comes down to your time horizon. This is not a quick flip.
No.
This equity is best viewed as a multi-year hold, requiring a steadfast 12 to 18-month horizon. As an investor, you have to give the complex regulatory approvals the necessary time to clear.
Right.
You have to give the tech and cultural integration of these diverse financial firms time to take place. And most crucially, you have to give that massive operating leverage, that 14 million fixed cost margin expansion time, to actually flow through and compound on the quarterly earnings reports.
It requires a lot of patience.
It does. But the asymmetric wealth building upside of crossing that fixed cost inflection point is incredibly substantial.
Which brings us right back to the survival story we started with. They didn't just survive the harsh wilderness of a financial death spiral. They mapped the territory, they built a highly profitable fortress right in the middle of it, and now they are aggressively buying up all the surrounding land.
That's a great narrative.
But it leaves me with this final structural thought for you listening to chew on. If massive incumbents like Fidelity and Pershing are structurally forced to ignore these financial startups and broker-dealers under $1 billion in revenue because of their legacy tech stacks, what happens when AtlasClear successfully consolidates this entire overlooked ecosystem?
That's the million-dollar question.
If they truly become the indispensable vertical backbone for the next generation of agile finance, won't the very giants who ignored this niche eventually realize they missed the boat and be forced to buy AtlasClear out at a massive, massive premium?
It's a structurally sound question, and looking at the history of Wall Street consolidation, that is exactly how these market dynamics tend to play out.
Definitely something to keep a close eye on as the story unfolds over the next few quarters. Thanks for joining us for this analysis of the numbers, and we'll catch you next time.